Hey everyone, Couch Investor here, back with another video for you today. In today's video, we're going to rank the best and the worst e-commerce stock out there. We did the same thing last week for EV stocks. If you haven't watched that, it's going to pop up right here. And before I get into this video, if you haven't subscribed to this channel, help me reach 4,000 subscribers. We're almost there. So hit that subscribe button. And if you like these videos, leave it an early thumbs up, as it really helps me out grow the channel and get my videos out there. So without further ado, let's dive into this. Alright, so let's first start with the most obvious one, which is Amazon. Look, I would like to put it in the good section, not because Amazon isn't an amazing company, just because for the growth potential, I feel Amazon is reaching its highest possible year-over-year growth. And actually we can see it right here on this graph. There's a slowing in growth in the e-commerce giant. They expect it to peak this year. Well, it peaked already a couple of years ago, but for this short-term period of 2020 to 2025, 2020 should be the peak. And then in 2025, 2026, we should reach the lowest point at around 12% year-over-year growth. But if you look at the charts right now, it broke the uptrend line last week after that market crash. Now we're making our way up. We can see here that the support line at around $3,100 stood nicely, and now we're just waiting for it to make its way all the way over to $3,400. Obviously, I would like to see Amazon have a stock split in the near future because, well, as of now, it's becoming a bit expensive for the retail investor. And next up, we have another stock I already covered, I think a month or so ago, in my top 5 buys for the month of August. If you haven't seen my top 5 buy for the month of September, it's going to pop up in the top right corner. But for this one, it's eBay. I put it in the underrated section. The underrated section has nothing to do with amazing or not amazing, good, not good, because obviously eBay could have been in the amazing or the good section, but I will put it in the underrated one because it's a stock that is flying right now under the radar. There's going to be a lot of restructuring at eBay, hopefully soon. There's a new CEO, like I said in my last video. There's a CEO that came from Walmart. He was the COO there for the e-commerce side of the business, which is growing immensely because they wanted to go head to head with Amazon. And now he's going to, well, he went to eBay, became their CEO, and hopefully he can make some good advancements in the company. And right now we can see solid growth for eBay. We see here eBay experienced an impressive 18% increase year-over-year revenue to $2.9 billion. Obviously, that's nothing compared to what Amazon is doing at around $89 billion or so. For its second quarter, this growth was fueled by a whopping 26% increase in gross merchandise volume, which represents the total value of transactions processed through eBay. GMV reached $27.1 billion in Q2, a significant reversal of past year's trend. We can see right here, there was a bit of a slowdown, but this year we've seen, maybe it's thanks to the pandemic, let's say, that this is happening right now, but hopefully they can continue their growth year over year. Looking at the graphs right now, support right around here is where they tried to break out last time and where the breakout actually began. I would like to see the stock go back over $55 and then make its way up to the $60 marks. But again, eBay is a long play. That's why it's in the underrated section. You can buy now and wait for the next 5 years. It can become and transform into this new huge e-commerce website that we've known eBay to be. But most of the people that go on eBay are looking to buy things secondhand, have great deals, etc. Maybe they can change it. Maybe they will partner up with other brands as well. It remains to be seen. And next up, we have a company that one of my subscribers actually mentioned. It's ChannelAdvisor. As of now, I put it in the OK section. If there was a section between OK and meh, I would put it there because it's pretty risky to invest in that company. But overall, again, another young and exciting, maybe exciting e-commerce website. So let's first look at their revenue above estimates last quarter. So they reported earnings of 25 cents per share on revenue of $37.4 million. Consensus was 24 cents per share on revenue of $32.7 million. Revenue grew 17.3% on a year-over-year basis. Now, what do they actually do? So ChannelAdvisor's mission is to connect and optimize the world's e-commerce By integrating to the ChannelAdvisor platform, brands and retailers can better execute against their multi-channel e-commerce strategies, all within a single platform. So why should you use ChannelAdvisor and not, let's say, Shopify or another platform? So they say we're more than just a platform. As your partner in e-commerce success, we're here to help you efficiently acquire more customers and increase sales. Since 2001, so pretty old, our leading technology and e-commerce experts have helped our clients from leading global brands and retailers to mid-sized businesses and entrepreneurs grow. So as you can see here, what you can actually do on the platform is digital marketing. You can relocate your customers to various websites, whether it's buy online or buy local, connect various marketplaces, optimize your fulfillment methods, and have first-party 1P. Now, this all looks actually very exciting to have all of that in one platform and on one website, and it can actually help you grow your business if you start with ChannelAdvisor and not maybe another oversaturated website. So it remains to be seen. As of now, they have a market cap of just under $400 million. But let's go and look at the graphs right now. You can see again, one of those stocks that went all the way up. Earnings weren't that good apparently for the market because they just beat it and maybe not by enough. Went down, then picked its way back up to around $20, and then market crash. We've seen it go down pretty much to around right here. Obviously, for the whole year right now, I think they've done pretty well. As if you can see right here, they were at $9 at the start of the year, lowest point at under $5. So you could have doubled, tripled, and quadrupled your investment if you bought in earlier this year. But overall, I think it's okay to say that they are in the okay section right here. All right, and next up is a stock we all know as well. It's basically the Amazon of China, which is Alibaba. We all know the website AliExpress, where you can buy almost everything you want for cheaper. Sometimes it's fake, sometimes it's not. Who knows? It's just cheaper. And for some of us, that's good enough. So Alibaba, for example, is a huge corporation. As of now, they have a market cap of just under $6 trillion. That's the whole Alibaba corporation. Now let's go and look at the graphs real quick for that. We've seen that the top was almost $300. Then the stock went back down and it actually survived. I thought it would drop a bit more to around, I don't know, 260 or so right here, but it actually stopped at its previous stop, which makes a bit of sense, right around $270. Now, over the long term, I think Alibaba is a very, very good stock to have some exposure in the Chinese market is pretty good and pretty necessary right now. But we can see here that Alibaba is expanding its operations outside Chinese borders, including a deep interest in starting direct e-commerce operations in the United States. Whether or not that will happen, I don't think so, with the political tensions between Washington and Beijing is making that ambition difficult to pursue right now, but we should all keep an eye on that. Now, looking a bit at their numbers that they reported, so Alibaba's sales rose 30% year over year to $21.8 billion in August's first quarter's report. Earnings increased by 15% to $2.10 per share. The results breezed by Wall Street's consensus estimate, which had pointed to earnings near $1.98 per share on approximately $21.3 billion in top-line revenue. So again, overall, obviously, if you picked it up a bit earlier, that's a great company to have in your portfolio, especially to get that extra exposure out there. And next up, we have another Chinese company, which is JD. I will put it in the good section because it's not quite there yet to be at the Amazon and Alibaba's level, but JD, same thing, is another top e-commerce website. So JD is the largest direct retailer in China and the second largest e-commerce company after Alibaba, of course. But unlike Alibaba, which doesn't take on inventories at its own top marketplaces, JD takes on inventories and fulfill its orders with its own warehouses and logistics network. In the first half of 2020, JD's revenue rose 28% year over year as its adjusted earnings grew 21%. Its sales remains robust throughout the crisis and its growth and annual active customers accelerated significantly as it gained more shoppers from China's lower tier cities. Its annual 618 shopping festival in June also significantly boosted its second quarter sales. Now, Wall Street expects JD's revenue and earnings to rise by 30 and 52% respectively this year. JD's stock trades at over 50 times forward earnings, but that valuation is actually quite reasonable relative to its dazzling growth rates, which makes total sense if they can keep that 30 and 52% rise this year. Those 50 times forward earnings are going to be very, very cheap looking at that stock right now. We can see again, very good year. This year started at around $40 or so, made its way up to 80. Obviously, we've seen some stocks quadruple during that time, but overall, this is again a company that will go even higher in the future. I can see the stock go over the $100 mark pretty soon. And next up, we have another company that is pretty popular this year, which is Shopify. I'll put it again in the good, but if there was a category between good and amazing, it would have been there, because putting Shopify and JD right now in the same category feels a bit weird, but that's what it is. Overall, again, Shopify, again, one of those stocks that has been on the rise this year. Crazy growth, not only in the stock price, but also the company itself. We can see here that Shopify's second quarter sales skyrocketed 97% year over year, spurred on by new merchant partner addition and a 190% increase in gross merchandise volume for its stores on its platform. Revenue of $714.3 million crushed the average analyst estimate for sales, roughly of $500 million, which is nothing. While the virus disrupted conventional brick-and-mortar retail operations, Shopify benefited from offering the right services at the right time. Again, this is something very important, especially for everyone that has invested in the e-commerce business and stocks. E-commerce is going to be huge. It is already huge, but it will just grow more and more as the years go by. Shopify, like other e-commerce stocks and companies, will continue to grow, and the more competition out there, the better it is for us, the consumer. And next up, we have another underrated stock, which is Etsy. If you don't know, Etsy is this website where you go and you can ask someone to create and craft a specific product for you. Most of the products are very familiar to what you can find elsewhere, but there you can personalize those things and let someone create. Let's say you need a new background for your filming space, you can ask someone to create that for you. But the major thing that happened on Etsy recently is personalized masks. As public health officials encourage Americans to wear fabric face masks, that became Etsy's moment of opportunity. The company witnessed a tremendous surge of demand for handmade artisan face masks. The results? Etsy sold about $133 million worth of fabric face masks, about 12 million of them in the month of April. Now the trend continued when Etsy reported second quarter's earnings on August 5th. Etsy sold $346 million worth of masks, but the strength of the second quarter was about so much more. The CEO said non-mask sales grew 93%. That's an acceleration of 79% that non-mask sales grew in the month of April. And some other good news for Etsy holders, not so much for us Tesla holders. It has been added to the S&P 500 and not Tesla, and that's why we've seen a little rise when that announcement was made. But overall, this stock this year has been pretty much going on a rise, 3 times, maybe even 4 if you bought it at its lowest point there in March. But overall, again, Etsy is one of those stocks that if you buy, you have to buy it for the very, very long term. Next up, we have BigCommerce, an IPO stock in the e-commerce industry that IPO'd a couple of months or so ago. Again, one of those stocks that one of my subscribers actually mentioned. As of now, we're going to put it in the okay to underrated section, as it's still early stages, still in IPO growth stage. But as we can see here on the graph, it came out at around $70 or so, made its way up to almost, well, to over $100, then went all the way back down to $65, and then it grew 132% in a matter of a week. Obviously, right now the stock is down by 50% or so. So if you say, okay, maybe I'm going to buy the dip because I think this is a support line right here at around $94, $95 or so, be my guest. But as of now, like we've seen with Lemonade, IPO stocks are very, very volatile. In this case, they are still up by a lot, by almost doubling right now since the day they came out of their IPO. But why should one buy BigCommerce? What's their advantage over a company, let's say, like Shopify? So we can see here BigCommerce has a solid positioning in this market, which is the e-commerce market, powering 60,000 plus online stores as of June 2020. But more importantly, BigCommerce has enough distinct advantages over Shopify in certain areas that the platform is a better option than Shopify for many sellers. For example, BigCommerce features 0 transaction fees, whereas Shopify takes a 0.5 to 2% commission of every transaction. Plus, BigCommerce has far more robust product listing options, more APIs, better multi-currency solutions, tiered pricing structures, and more streamlined customer upload options. Now, obviously, when it comes to e-commerce, it doesn't really matter where you create your website. It really matters how you optimize your website. So you can create your website on BigCommerce or on Shopify. It doesn't really matter as long as you know how to optimize and how to market your online store. You will be very good, but it's always good to have less fees, obviously, more options to integrate. I think there's also an integration with Facebook that will be coming soon. It might surprise some of you, but I think some of the big companies might actually acquire such companies, such as maybe Facebook might acquire, let's say, BigCommerce or ChannelAdvisor to integrate it with their Facebook marketplace. Who knows? But as of now, again, very volatile. If you're happy with that, if you're in it for the longer term, you can always dollars cost average. But as of now, for me, look, I think this company has lots of potential, but right now I don't think it has a spot in my portfolio. And lastly is C. I will put it for sure here on the good segment. Again, if there was a section between amazing and good, C would be there as well. I think C is one of the favorite e-commerce stock here on the channel. I've never spoken about it, but I always see it in the comment section. So here it is. If I could, it would be higher, but as of now, it will have to be just under the amazing Alibaba and Amazon. So right now, we can see here again that this year, this company has been rising like crazy. Started at around $40, made its way all the way up to $160. Now we're down a little bit. Obviously, there was a gap right here. It got filled and the crash actually stopped right at that day and price of $135 or so. If you picked it up right here, pretty good buying the dip right there. Because overall, the company, we can see here, adjusted revenue rose 93% annually to $1.29 billion, beating estimates by $230 million. It posted a positive adjusted EBITDA of $7.7 million compared to a loss of $11 million a year ago and analyst expectations for a loss of $41.9 million. Now, a couple of reasons why I like this company. First of all, let's start with here, this guy's number 2. It's also in the gaming business. The gaming business is becoming huge. But before I get into the gaming, let's first look then at the e-commerce side. C owns Shopee, which sponsors, if you might have seen some ads, with Manny Pacquiao, the famous boxer, one of the largest e-commerce marketplaces in Southeast Asia. All right, one thing, C is not a Chinese company. It's from Singapore, where Mr. Chicken is at. So shout out to him. Its main competitor is Alibaba's Lazada. Shopee remains unprofitable due to its aggressive promotions and subsidies, including free shipping and financial support to its sellers, and people believe that those losses would widen in a prolonged war with Lazada. So going back to their gaming business, they have this thing called Garena, which offers licensed games from Tencent, one of the biggest gaming publishers, I think, out there, as well as first-party games. So during the second quarter, the digital entertainment group, which houses Garena, grew its adjusted revenue 62% annually to $716.2 million, as its adjusted EBITDA rose 65% to $36.2 million. So there you have number 2. We have e-commerce, gaming, entertainment, etc., which is already a big chunk of what is growing very fast in the world right now. Again, strength throughout this pandemic, e-commerce and gaming gaining more market share day in, day out. And lastly, for guidance, they didn't provide any, but analysts expect its revenue to rise 57% this year and 39% next year. That growth rate could justify C's premium valuation as long as the growth of its gaming business continues, offsetting the narrowing losses of its e-commerce business. Hitting C could pull that balancing act off and its stock could head higher. Like we've seen here, we've seen a nice healthy dip. I think this is a nice time to acquire some shares if you're in it for the longer term. As of now, I think the market cap is around $60 to $70 billion. So there's still, in my opinion, a long way to go. Obviously, I would like them to sort out their e-commerce problem, maybe acquire some other company, grow into other areas, because as of now, they're still losing a lot of money with their promotions, free shipping, helping sellers out. But maybe that's just an early strategy to keep sellers. Same thing that Square has done during this pandemic is offer help to its customers. Then there's more stickiness. People like the company more and are unlikely to go and leave them in the longer future. But as of now, I think this company is great. It's in the e-commerce segment. It's in the gaming segment. What else do you want from a growing company nowadays? If you want me to rank other stocks in a particular segment, let me know down in the comments below. And let me know as well down in the comments below which e-commerce stocks you are holding in your portfolio, which one you're keeping an eye on, which one you have already bought this year. Let me know down in the comments below. And if you have watched until now, you're a real legend. And that will be it for this video. If you liked it, consider leaving a thumbs up. And if you haven't subscribed yet to this channel, maybe now's the time to hit that subscribe button. We're on our way to 4,000 subscribers. And as always, guys, take care, stay safe, and see you all in the next video. Bye bye.